Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. Well, it's been quite a week. Geopolitical tensions, central bank meetings, the worst start for the S&P 500 on record, at least through the first 16 days of trading. A lot going on. We've been talking about Q1 volatility, but there's even more going on than what we had imagined. So let's take some of the top issues here one by one. First, in the central bank front, this past week, we saw the Bank of Canada and the Fed both stay on hold. Longtime listeners know I do pay attention to Canada because sometimes they're slightly ahead of the other Anglo central banks in policy action. But this time they remained on hold despite saying all the metrics they look at justified a hike. But it was a hawkish hold as they made a clear indication that rates are heading higher soon. That was indeed a preview of the Fed where they gave us a similar outlook, holding rates unchanged, but explicitly saying, and I quote, "The committee expects it will soon be appropriate to raise the target range for the federal funds rate." We expect that to happen in March, and as the Fed also indicated, for QT to happen soon after. But the Powell press conference was really the hawkish part of the whole day, because he reinforced this hawkish message consistently and throughout the press conference. In fact, it has us now pulling forward our expectations for Fed rate hikes, seeing 5 this year with a front-loaded starting in March, then in May, and then in June, slowing a bit to September and December, but then an additional 4 next year. Markets did adjust to that to some degree with rates moving higher, which also pressured equity markets. But the other factor, besides the higher rate outlook that's been weighing on risk assets in general, has been earnings, but also more recently, clearly, it's been the geopolitical situation in Ukraine and Russia. And that's here that I actually want to bring in Global Head of Emerging Market Strategy, Alvaro Vivanco. All right, Alvaro, a lot going on. It's a fast-moving situation. Things could even change between this recording and when it's released on the airwaves. But get us up to speed. So where are we now as you see it with this situation?
Thank you, John. Yeah, things can move very, very quickly. There's a lot of headlines coming day by day. The most recent one is that Russia will take, I guess, a few days to respond to the written commitment by the US about NATO, right? So far, the headlines have not been particularly optimistic, right? Saying that there is, quote unquote, a negative response from the US, but the situation can change very, very quickly. On the more positive note, also this morning, we got some news that military forces will leave Belarus following the military exercises, which, at least for the very, very short term, gives us a little bit of a wider window into the negotiations. Let me just spend a couple of minutes on the broader context, right? I think it's important for investors to realize that this is something that Putin has been working for a long time. They have been preparing for this. So it's a much wider strategic move that even goes beyond the interest in Ukraine. And second, there is an important timing component to it, not just because of the weakness perceived by the rest of the world in terms of the Biden administration after Afghanistan. There's also elections going through here, the midterms, presidential elections of Biden down the road, as well as in 2024, Putin himself facing elections. So I think that's important. The other point is that oil prices matter, right? And the constraint politically in the US and Europe that inflation is causing, I think kind of create a very auspicious time for Biden to make this more aggressive moves, and that's where we are. So a lot of news, a lot of headlines. What has been interesting for me to hear, having talked to a lot of geopolitical experts, is that most seem to agree that some action will be taken by mid-February. So I think that it's a matter of weeks rather than months, at least, to have the first initial move by Russia.
All right. When you mention initial moves by Russia, what are Putin's options here? Where do you, it certainly seems like that now we're waiting for his next move.
Yeah, we put out a piece this week that kind of describes some of the options. It goes all the way from finding a diplomatic solution that will still give, Putin the option of selling that domestically. There are some quote unquote tactical military options, which could involve some relatively small incursions or invasions into the eastern part of the Ukraine, where there are the separatist groups that Russia has been supporting for a long time. There's also the possibility of increasingly moving west, and there isn't. We shouldn't take it off the table completely, although there are very important constraints. The possibility of a full country and a full invasion of the Ukraine, including the capital. Most people will agree that that is an extremely risky move by Putin. There are some constraints just in terms of whether the ability of any military to carry urban warfare is extremely, extremely challenging. Russia, the US, they have all learned that over history. So I think that the kind of the two extremes are very unlikely to happen. But even within that range of exactly how far to take the invasion, there's a lot of possibilities and a lot of uncertainty.
All right, so what about the other side on the West? I mean, a lot of their responses will depend on Putin's actions, certainly, but what are the actions they could take, perhaps from like least to most severe?
Yeah, I mean, I think that the first point is that they should be proportional, right? That this provides the incentive for Russia to restrain themselves, that they're going to face increasingly severe consequences the farther they take it. There's also a very good template in a bill that Senator Menendez has introduced that lays down some of these options. So I guess there are four things that are currently on that bill. The first one is just limited transactions of Russian debt. I don't think that has much bite. It even doesn't include previous issues of government bonds. It only applies to the new ones. The second one is some sort of limit or challenges to the Nord Stream 2 pipeline. That's going to require a lot of negotiations with Europe. The pipeline is not yet operational, but has been completed. Obviously, given the context of much higher energy prices in the US and in Europe, I think it's going to be very difficult, but it could be put on pause. The other two are a little bit more aggressive, right? The next step will be to include a wider list of companies and maybe banks. The way the bill sets it up is that there will be 3 Russian banks that will be sanctioned the same way that few entities have been over the last few years. The problem for the West on that is that it could have a lot of unintended negative consequences for markets. And obviously, as you mentioned, there's a lot of uncertainty already. Just from a pure political perspective, right? It's difficult for the West to inject a lot of volatility into the market, knowing that the negative consequences for Russia will obviously be there, but that they could withstand those for a lot longer than previously was the case, as Russia has prepared for this, right? So maybe there's going to be a little bit of restraint on that. And the last one, which definitely falls into this category, is eliminating SWIFT out of the Russian financial system. That's very, very difficult because Russian banks and companies are integrated. You need to send back gas payments from Europe. So I think that that's going to be the last option that could really hurt a lot of different Western companies and interests. And I think for now, at least from the European side, it seems to be off the table. There's 2 other possibilities out there that have been mentioned more recently. One is, sanctions against Putin himself. I think that that's not going to have much consequences. And the other one is limiting exports to Russia of key technological inputs such as chips, which was done in the context of China. I think those are on the table, could potentially be included as well.
All right, so bigger picture, I wrote almost 2 weeks ago, this felt like a risk that everybody saw coming, but didn't really do anything about. Do you think markets right now, again, things change quickly, but at the moment, do you think markets are priced adequately for the risk of this situation?
I think the quick answer is not really, right? I think that there's two reasons for that. The first one is just the uncertainty that we mentioned. It's very, very difficult to have conviction on any of these different scenarios, and then you get into game theory analysis of what would be the response back and forth. And the second one, I think, is that we as financial analysts and investors have really not been trained to deal with this kind of geopolitical events. Over the last 20, 30 years, our bias has been always to fade this kind of noise. Just having talked to a few clients and a few geopolitical experts, you see this massive divide. The experts are really, really concerned that this is going to happen. Investors tend to see it obviously as a risk, but something that should be faded at some point. So, you look at the way, even treasuries have been trading. Obviously, risky assets have been, I think, mostly responding to a more hawkish central bank pressure. But I think even for Russian assets, right, the ruble obviously has moved about 5%. CDS have spiked at certain points. But I just don't think that the market's really pricing this in. And obviously, we all don't want to get there. But it seems like there's a little bit of wishful thinking that we all have going into this kind of scenarios.
Yeah, unfortunately, I tend to agree with you on this situation, especially given the timeline. You could have a period where things lighten up as letters are sent back and forth. And then, given that mid-February timeline you talked about, not that we would be blindsided by it, we might be lulled into some sort of comfort as we go forward. All right, Alvaro, that was really, really insightful. Thank you so much for joining us. I mean, from my perspective, I just want to close with the broader observation that even though we've had significant risk-off environments of late, we haven't seen traditional safe havens perform as well as they have in the past. I mean, even when equities were at their weakest, and some of these Russian tensions were hitting the hardest, and hawkish central banks communicating to the markets, you've seen government bonds barely rallying. Even things like gold hasn't really valued that much. Government bond side makes sense because in a high inflation environment, the hurdle for central banks to get derailed from their rate hike plans is much higher than in the past. And this is, again, something we're not particularly used to because we've been in a period of low inflation for so long. But even when you see like precious metals barely rallying, as I mentioned, Swiss francs rallied against the euro, but versus the dollar, there hasn't done much. I guess my point is that in the last 10 years, we've become used to certain correlations. We need to entertain the idea that the usual stocks down, bonds and gold and other safe havens up, they might just be different in a high inflation environment with different central bank reaction functions. So I just want to throw that out there for food for thought, especially if we do see a further deterioration in the Ukraine situation, that investors looking for traditional safe havens, we need to be cognizant that some of the old correlations may not hold. So that's it for this week. In the coming week, obviously, we have the fluid situation in Ukraine, but also watching, so we're going to have some Fed speakers, including testimony from new board nominees middle of the week in the US. And we get, as usual, the top tier manufacturing data and employment data. Europe has the January preliminary CPI data. We get final PMI data in Europe as well as the UK and the rest of the world. And of course, on Thursday, the 3rd, we have both the ECB and the Bank of England meetings. The latter, which we see a 25 basis point hike. And in particular, we're watchful, especially after this past week, to see if the Bank of England signals a higher policy path than they did in November. We'll have more on that next week. I have Ross Walker on, but best of luck out there. Have a great week. Thank you, everyone. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.